studio in New York City. I'm Julie Hyman. That's Maddie Mills today. Madison Mills sitting in for Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. We're an hour away from the close on Wall Street, and stocks are kicking off a new month with gains across the board. And guess what? Records again, on track at least for the Nasdaq and the S&P 500. Historically, though, March is not a good month for markets. We're looking at what to expect and how to position your portfolio.
And some big aerospace news because Boeing reportedly in talks to buy its key supplier, Spirit AeroSystems. That's a company it once owned. Now, this news coming as the jet maker faces ongoing scrutiny of its 737 MAX jet after that door plug blew off mid-flight. Spirit facing its own concerns over manufacturing. We're going to take a closer look at whether a deal would make things better or worse.
Plus, a new edition of Goodbye or Goodbye. The AI hype is all around Nvidia, but we have a pick in the chip space you might want to consider adding to your portfolio, according to our guest. All of that and much more ahead this hour. Let's get you up to speed now on the market action as we look at the three major averages rallying on the day here. We've got, again, the S&P 500 and the Nasdaq set to close at new records. The Dow not quite at that level again. But we've got tech, the information technology index within the S&P 500 that's leading gains. Not surprising, given that the Nasdaq's up more than the other major averages, up by about 1.25%. The S&P up about 0.8%. The Dow, the laggard today, up just about 0.1%. That's about 73 points. We do have utilities, the group that is lagging today, but along with tech, energy, and communication services are leading the way higher.
Well, Julie, it seems like the market is overlooking the macro here, which started with a big call from Apollo Global's chief economist Torsten Slok, not expecting any rate cuts for 2024. In a note this morning, Slok wrote that the Fed will not cut rates this year, and rates are going to stay higher for longer thanks to those stubborn inflation pressures. And Julie, it was interesting being at the stock exchange this morning because the traders themselves were talking about how this market continues to be so frothy and, move forward on this AI-driven rally. And I'm curious when the macro picture is going to start to impact that, particularly as earnings season starts to come to a close. What will be the catalyst for more of those highs that you were mentioning?
Yeah, I think it's a great question. I want to linger on Torsten's call for just a second here, because he's the first one who has said this, at least the first most prominent voice to have said, maybe we just won't get any cuts this year. And I think that the reasoning behind what he's saying is the reason that the market has held up relatively well, even in the face of delaying these rate cut predictions. And that's that things are going pretty well, right? From a macro perspective, that the economy, as he says in his note, is not slowing down, it is re-accelerating. That's the reason that we have some of these stubborn inflation readings for the month of January, even the likes of Austin Goolsbee on the Fed are saying January was sort of a one-off, and many other economists agree. But here you've got Torsten saying super core inflation, which of course is one of the ones that is favored by the Fed, the measure favored by the Fed, the Fed is trending higher. And so, if they're not cutting because the economy is relatively strong, maybe that's something that the market can still rally into, but I think it depends on how long it lasts.
It's a great point that you bring up, though, this idea that why would they cut if they don't have a reason to yet? If they're not seeing any material weakness that indicates some type of sickness brewing in the economy, what would be the catalyst for cutting? And Barkin talked about that a little bit as well, saying that we don't necessarily need to push for cuts. Bostic also saying, I'm willing to wait. I'm interested in, I feel like a year ago, the market would have been down on a day after hearing commentary like that. We're still record-breaking highs day after day. I guess Nvidia beats the Fed is the takeaway.
Maybe, but let's get another take on this.
Yes.
Someone who spends all of his time thinking about this stuff for more on when or if we can expect the Fed to cut interest rates and the effect that that will have on the market. Let's welcome in Michael Kantrowitz, Piper Sandler Chief Investment Strategist, by the way, who just raised his target for the S&P 500. Michael, thank you for being here. So maybe you can help us out here, right? Because we do have the market perception of the Fed's cutting getting pushed back. We have Torsten Slok of Apollo today saying maybe it won't happen this year at all. Why aren't these types of perceptions more problematic for stocks?
Well, hi. I think part of it is that people think the Fed is still done. And I think Powell's been pretty clear on that since December 13th of last year. So I think the reaction function to higher rates year to date hasn't been as detrimental. And I think ultimately the areas of the market that continue to do well are the areas where earnings estimates continue to increase, namely large cap growth stocks. So the combination of being a little less worried currently about the Fed having to raise rates or not, perhaps not cut rates, has changed. Certainly, I think it was a little ridiculous that the market expected 7 rate cuts at the beginning of this year. So we've kind of normalized that, and current rate expectations are pretty close to where the dot plot is. So I think the market's kind of realigned for more of the current reality. And I think going forward, we'll continue to see a lot of data dependency, but we think the Fed has to cut rates later this year because I think a lot of the upcoming refinancing issues for the US government, commercial real estate, some of the regional bank issues that continue to weigh on that space, and corporate credit could become a bigger issue than inflation remaining sticky later, into 2025.
To what extent has the AI-driven rally played into your view, your more bullish view than some of the calls that we've been talking about? And I'm asking because I'm curious about whether or not, if the Fed ends up not cutting this year, like Torsten is anticipating, does that start to weigh on this idea that it's all about AI and we can continue to ride that wave?
I think AI is a big part of obviously what's lifted, especially a bunch of large stocks, very visible to the investment community, like the Mag 7. But when you look at leadership across the market, I think the story's far greater than that. There's pockets of even small caps, where the indices have gone nowhere for 2 years, where there's pockets where earnings have been stronger in industrials, for example, or areas of that market that have stronger balance sheets or higher profitability that have done quite well. But I think there's a bit too much focus on AI, and I think there's a lot more going on underneath the surface of the equity market that can keep things afloat as long as we don't either see a big spike in the unemployment rate or a big spike in inflation expectations.
Michael, if you, as we mentioned, you just recently raised your year-end target for the S&P 500 to 250. That's still not that far above where we are already, right? With the rally that we've seen, I think it's a little more than 2% above current levels. But what would need to continue to sort of go right in order to continue to see that kind of a relatively modest rally through the end of the year?
Yeah, well, I think if we. I think we're kind of in this tug of war where if the economy slows a little bit, like today we got soft manufacturing data back in contraction, though the good news and why the market's up, I think largely today, is because that data both weakened and inflation expectations or prices paid declined, softened. And the equity market is so overly bond yield focused today, and softer macro data will be, I think, bullish for equities if it's bullish for bonds to a point. And I think that point where it becomes a problem is farther away, whether it's at claims at 275 or 300,000 on initial claims, or the unemployment rate at least above 4%. So I think right now some soft macro news is going to be actually how we carry the weight of the multiples slightly higher from here. And I think this the market rally is going to go from AI themed to bond yield themed.
Well, let's talk about that bond rally that we've been seeing. It seems like the stock market clearly has not been shaken by the bond rally, and that's typically the kind of dynamic that we see between the two. Should equities be caring more about what's going on in the treasury space?
Well, they are, absolutely. In fact, small cap stocks have never been this positively correlated with bonds or bond prices. So take the TLT ETF and the Russell 2000. That data goes back to the beginning of the Russell in 1978. So they've never had such a strong correlation. And of course, that's because you have a lot of regional bank stocks that have interest rate issues. You've got commercial real estate exposure that plays into that. You've got a lot of zombie companies in the small cap space. So if you think about all the problems I'm guessing you talk about with your guests and people on Wall Street, investors are speaking about, fiscal deficits, commercial real estate, or refinancing, that is and
are preparing an IPO this month.
Lower rates can start to heal some of those concerns in the near term. So I think there's kind of a bit of bad news is good news, more of that ahead of us. And that's why I'm actually more bullish on the market. It's not because I'm super bullish on the economy. It's actually because I expect to see softer macro data over the next 6 to 9 months, not contracting, not terrible, but I think that's going to lead to a bond rally and an equity rally.
And then finally, let's talk a little bit about more specifically how to play that view. You like what you're calling QARP, quality at a reasonable price, a little bit of a twist on the old GARP, growth at a reasonable price. So what does quality mean to you?
It means companies that are highly profitable. It means companies that have realized earnings growth. It means companies that have high quality or free cash flow, high free cash flow yield. So, last year we were big bulls on in terms of positioning on quality, growth and profitability at any price. Whereas this year we think investors are going to be more valuation discerning. So I think avoiding some of the really expensive stocks makes sense, but not necessarily avoiding all the stocks that have been doing well if they've got continuing fundamental momentum. So quality at a reasonable price makes a lot of sense to us. And in the scenario where that doesn't outperform is either if we get an immense bond rally without a recession, which I think is kind of low odds, or a broad-based sharp earnings reacceleration, which without the Fed cutting rates imminently is also, I think, a low odds scenario. So I think being too bullish or too bearish in terms of positioning doesn't make a lot of sense this year, and kind of focusing on where companies have that better fundamentals makes sense, and overlaying that with some bond sensitivity, if you will. So we do think yields will be lower as the year progresses, and the Fed will need to cut. And so we do want to be exposed to that, but we don't want to necessarily just recommend, nor can we all just buy regional banks and home builders or commercial real estate.
Right, as you say in your note, a little bit of a bond kicker to top it all off. Michael, we'll have to leave it there, but thank you so much. We really appreciate you joining us. Michael is with Piper Sandler as their chief investment strategist. We're going to get to some trending tickers here. Shares of Boeing and Spirit AeroSystems moving as we head into the close here. Boeing is down 1.5% almost. Spirit surging on the news, up almost 14% this after news that Boeing is in talks to acquire the supplier Spirit AeroSystems. That news first reported by the Wall Street Journal. And Julie, I know we've been talking about this today, but I'm curious about whether this is an effort for Boeing to kind of shore up their supply chain after the obvious challenges that they had with their aircraft following that door frame falling off. Spirit did build that airframe that had that door fly off mid-flight, but I'm very interested in what their thinking is on how viable of a strategy this is going to be moving forward.
Well, I mean, there are a lot of questions about this, right? Because Spirit AeroSystems, even before this latest trouble, had sort of struggled financially, and Boeing, as its former parent company, it spun it off in 2005, had to do some various cash infusions to try to shore it up as well. So is the thinking that Boeing will have an easier time having it back under its own umbrella? Of course, there are a lot of regulatory questions about all of this as well. As we know, Boeing as well as Spirit AeroSystems are each under regulatory scrutiny following that accident that you alluded to. So I just think there are a lot of questions about this.
Right, a lot of questions, but it does sound like, I mean, Boeing does have some decent cash on hand, like we were talking about, I think to the tune of 16 billion-ish. So it's not nothing for them to be able to play around with.
Right.
Yeah.
We'll see. We're going to talk more about this later on in the show. We are also watching tech again today. As we mentioned, technology, the best performing group today in the S&P 500. Dell is definitely a big part of that. Those shares hitting a record after it reported revenue above expectations in its fourth quarter. It cited surging AI demand. That enthusiasm also prompting a better than expected outlook for the full year from the company. Other names in the chip space rising on the upbeat outlook. And in particular, what stood out to me from Dell's talk is that its infrastructure business was strong, in particular AI optimized servers that are powered by chips, which, by the way, Dell said were getting a little hard to get.
Well, hard to get is the story that's been kind of leading to such a surge in the chip sector. And that's part of the reason why we're seeing the Philadelphia Semiconductor Index on track to close at record highs today as well. That supply and demand relationship is what's been kind of leading to this chip surge. But they also mentioned that it really comes down to the specifics within the chips and the companies that are able to embrace some innovation when it comes to the chip supplies and silicon chips that are really meeting specific demands from companies companies, those are going to be the ones to look at moving forward.
Yeah, and also sort of on a related note, we heard from NetApp as well, which is a data storage company. Those shares are surging also, and that's after it also raised its outlook for earnings per share. So that too sort of part of a similar story that is this increase in demand for data, both AI related and not.
The chips that power it, and then the places that we store all of our data.
Exactly.
Two good places to be. A name that is not doing so hot, though, today. Shares of NYCB plunging today after the New York-based lender disclosed its fourth quarter losses were a lot worse than previously stated. They are down a little over 25%. Now, what's interesting is their tangible book value is relatively unchanged. That's according to Chris Marinac from earlier today. The broader regionals space, if you look at the KBE index, also not doing so great today. A little over 1.2% down as we head into the close here. But I'm curious about whether or not that downward motion that we're seeing in the broader regionals index is an indication that folks think this is a broader issue within regionals, or if they think this is NYCB specific.
Right. I mean, NYCB sort of it has made acquisitions, including that of Flagstar Bank, and Sandra Janello, who was the CEO of that bank, has now become the CEO of NYCB. Also, it acquired what was left of Signature Bank after it ran into troubles in last year's banking troubles. So I think investors just are not satisfied with this is sort of a TBD situation, right? The company said it had material weaknesses. It had a loan review that showed up that it had to write down $2.4 billion. So now what is next? Right. And I think that the sell-off indicates that investors don't feel confident that they know what happens next.
Not happy with that. And it's a challenge, too, for the regional banks that weren't able to stress test a higher for longer environment. If the Fed does start to actually pivot, it's not giving them a lot of time to stress test for yet another new environment we're going to be heading into.
Yeah, we'll see.
All
right. Yeah. Starting Monday, our final hour of market coverage is getting a new look. We're going to have you covered on everything you need to know to better fit your portfolio and dominate the markets. A full slate of guests on tap to kick us off next week, including Skybridge founder Anthony Scaramucci to talk crypto with us on Monday, Abercrombie & Fitch CEO Fran Horowitz on Wednesday, and RSM Chief Economist Joe Bruce-Wallace will talk to us on Friday to break down the February jobs report. Stay tuned. We're going to keep you locked in on the final hour of trading right here on Yahoo Finance. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern. As Disney CEO Bob Iger continues his fight with activist investor Nelson Peltz, he's getting some reinforcements from the Walt Disney family. Yahoo Finance's Alexandra Canal has been following the board seat battle. She joins us now with an update. This may be a little surprising.
Yeah, maybe a little surprising. And it seems like Disney has had a very busy week, right? I mean, we've heard a lot of announcements from this company, whether it be its retreat from India, whether it be the studio executive shakeup. But now, I think looking ahead, a big question mark for investors is this proxy battle. Will Nelson Peltz succeed in shaking up Disney's board? Is he going to get that seat that he really, really wants? But now we have the backing of the Walt Disney family, and this is an open letter. There were 2 open letters that were sent to shareholders from the grandchildren of Walt Disney and his brother Roy. There was one in particular that had some really fiery, choice words there. The grandchildren of Roy saying in part, quote, that he would be very concerned by the threat posed by self-anointed activist investors who are really wolves in sheep's clothing, just waiting to tear Disney apart if they can trick shareholders into opening the door for them. So not holding back there. They very much support Disney's current board. They very much support CEO Bob Iger. They admitted that they haven't agreed with everything that's gone on at the company, but ultimately they don't want Nelson Peltz and Trian Fund Management to infiltrate that there. There's also the investment firm Blackwell's Capital. They are pushing for their own board seats, but really more so an extension of the board rather than a full replacement that Nelson Peltz wants to do. So, there's just a lot of turmoil for this company. Wall Street viewers have viewed this as really a distraction for Bob Iger. There's a lot of other issues at this company, but this is all going to come to a head on April 3rd. That's when the shareholder meeting is, and that's when we're really going to find all of this out and the answers to these questions.
Exciting. A lot of good intel there that I feel like our next guest is probably going to have an opinion on, Allie.
I'm sure.
Thank you so much. We really appreciate it, as always. Thank you. Speaking of, we're going to continue on media streaming because Fubo TV reporting fourth quarter earnings ahead of the open, beating on revenue and revealing a new record for paid subscribers in North America. That stock, though, down today, getting crushed to start the year, down about 40% here. For more on Fubo TV's earnings and the streaming landscape, we're going to bring in Activate Consulting founder and CEO Michael Wolf. Michael, thank you so much for being here with us.
Great to be here.
As I mentioned, some of the top line numbers good, but a miss on revenue and subscribers for 2024 for the guidance there. What do you think about that miss, and what do you think is the biggest contributor to that?
Well, you basically have to pull back and recognize that what Fubo is, it's a virtual pay TV operator, virtual cable. And if you look at the business, we have about 18 million people in the U.S. households that are getting virtual cable. But Fubo is the smallest. You've got 8 million from YouTube TV, you've got another 4.6 million from Hulu, and you've got some others, including Dish. So this is relatively small. They have 1.6 million subscribers in the US and another 400,000. And they've lost almost 2/3 of their market value in just the last 2 years, even though they've doubled their income in the last 2 years.
So what does the future then look like for a Fubo? Does it get acquired by someone else, or what happens?
Well, at an enterprise value of roughly $700 million, it's going to be very valuable to somebody else. It's unlikely. This company, they keep losing money. Last year, they lost over $400 million in revenue. So the other issue is that as much as they've started off marketing themselves as a sports service, they cost at $80 for their basic package. They cost just as much as you having cable. And there's not a lot of difference between what you're going to get on Fubo TV. Now, they have a great Latin package. I can tell you that my kids have a lot more fun watching soccer in Spanish, and the Latin package is only $32. But so it comes down to their position in the market, their financials, and then ultimately how much it costs for somebody to buy the service.
You talked about the struggles, though, in terms of the market cap for the company. To what extent is that related to that joint venture between ESPN, Fox, and WBD?
Well, it's been going in this direction, and there's a reason it's down 8% for the day, which is that investors are very concerned, and the fact that the CEO of the company's had he's pulled no punches, very choice words we're talking about the partnership between Disney, Fox, and Warner Discovery. Yeah. And so, but even that partnership, it's expected that their package, they haven't publicized anything, but somewhere between $40 to $50 a month. And so, yes, that's a threat to them, but a great deal more of the threat is they're not just competing against Disney and those three companies. They're competing against Comcast and Charter and other big operators.
Let's sort of pull back even further, right, and just look at the streaming landscape overall, because it feels confusing right now. It feels confusing for viewers. It feels confusing for investors in terms of all the offerings that are out there. And now they're doing the bundles. And so, who do you think sort of comes out on top when all of that is said and done?
Well, first of all, they all keep saying they're going to finally make money and cut their losses. And they really don't have a choice but to continue to produce. And so we've got Netflix is going to continue to produce programming. Amazon is huge in comparison. And yes, it starts off being confusing with the subscriber. How do you know what show is on what network or what streaming service? So we have a couple of streaming services that are really here to stay, and it's Netflix, and Disney does have a bundle of Hulu and ESPN Plus and Disney Plus. What's fascinating is we're already seeing the rebundling in the same way we had cable. So Verizon just announced a service where they'll give you both Max and Netflix for $10 a month. So we're going to see the rebundling. Still, all of our research shows that the average American home is going to subscribe to at least 5 services.
Really?
They'll churn them, and that, by the way, is on top of the free services like Tubi and Pluto that they're going to be using.
I mean, it sounds a lot like cable, right?
It certainly does. And as soon as we get more live programming on these services, and then what's next is news, and it's a pretty great substitute for cable.
Interesting. Michael, thanks so much for your perspective. Really appreciate it.
Great to be here.
Good to see you. Well, a court ruling against AstraZeneca in its legal fight against the Biden administration over drug price negotiations. Our own Anjali Kamlani has been following this very closely. So talk to us about this ruling and its significance.
Yeah, so this is the third strike against the pharma industry right now, with AstraZeneca being delivered the loss from the federal district court in Delaware. District Court Judge Connolly saying that the pharma company AstraZeneca is not entitled to sell the government drugs at prices the government won't agree to pay. And this is against that Medicare drug pricing negotiation that is a day before the deadline for these companies to accept the first round, the first offer essentially from the government. That is tomorrow. So this timing of this is the first company, it's important to note, that has had that has faced a loss. The last two were the largest business lobbying group, the U.S. Chamber of Commerce, and then the drug lobbying group, Pharma. So those are the two that have been tossed, but expectations are that these will all be appealed and eventually reach the U.S. Supreme Court. But as it stands right now, this is the third one, and we'll just wait to see what happens tomorrow.
Well, Anjali, this isn't the only big news on your beat today. We also had this Friday to come to an end. Yes. But big news from CVS and Walgreens announcing selling of an abortion pill. Talk to me about that.
Yes, mifepristone. That's one of the 2 pills used in abortion. The other one, misoprostol, we know is already available. And mifepristone was the one that the FDA allowed to then be sold regularly on the market over the counter. And this is where that starts off. Now, CVS and Walgreens coming out and saying that they will begin dispensing this month in select states, and then they're going to be expanding only to states where it is legal. We know that there are, of course, many cases in many states that have set up barriers and maybe not allowed pharmacies to dispense just because that's the way their abortion rules have been written, or for recently banned abortions standing in the way. So for any state that doesn't already have that ability, they will not be able to dispense there. But as of right now, this is moving forward on where they expect it to be with this dispensing.
All right, Anjali, thank you so much. Really appreciate you joining us. Hope you can get out of here after this. We appreciate it. Now, coming up on the newest edition of our series, Goodbye or Goodbye, we'll get an analyst's insight on 2 stocks to help you make the best choices for your portfolio. Stick around, more Yahoo Finance still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at the tech sector and two very different players. One that benefited from the consumer tech wave of streaming, and another that could be tipped for the next big thing, AI and business-to-business technology. So what's the best way to play it now? I'm here with Ivana Delevska, Spear Invest founder and CIO. Thanks so much for being here.
Thanks for having me.
So let's get to your buy stock, the one that you like here, and that is Marvell Technology. The stock's already rallied pretty well over the last year, but let's get to your investment case here. First of all, you say networking is experiencing explosive growth, and one of the ways you're looking at that is looking at the networking market, especially as indicated by Nvidia.
That's right, Julie. So the networking market is experiencing explosive growth driven by AI. And basically what's been happening is that players like Nvidia are introducing new products and players like Marvell are introducing new products in this market, and they're able to grow and capture more market share. So the surprise that happened, this market used to be a $2 billion market size, expected to grow pretty rapidly. All of a sudden, Nvidia reported $10 billion run rate. So the growth that's happening is just of meteoric rise, right? Like it's not something that we've seen before.
So in other words here, when we're looking at this Nvidia third quarter run rate, and this was the pre-existing estimates for the whole market. So obviously these are gonna have to come higher if just Nvidia is already at that level. Right.
That's right.
Okay, so let's talk about some of your other points here. Custom silicon is what we're gonna start to see here. What does that mean, and what does it mean for Marvell specifically?
So these are hyperscalers that are developing their own chips to compete with Nvidia. And a lot of them are doing this just so they're able to secure their supply, right? So you don't want to rely on one player, you want to have your own in-house design, and you would be using somebody like Marvell to help you achieve that.
Sort of as a contract player.
That's right. So what we're seeing, the networking piece is what started recovering this year, and it's going to continue in 2025. The custom silicon market is in earlier innings, so these companies are just starting to develop their own chips, so it's going to be a driver for next year more than this year.
Interesting. And so let's talk a little bit more about the cycle of where we are as well in non-cloud markets, and what that means for Marvell also.
So we just went through a downturn in non-cloud enterprise spending, and we expect that to be bottoming out this quarter. So we expect that comps are going to get easier, significantly easier, as we look out to the next few quarters, and that's going to be a pretty good setup for earnings for this company.
Well, like we always do, we like to talk about what is the potential downside risk for the stock that you like. And in the case of Marvell, there is competition, obviously, that's out there from some of the other big players.
That's right. And the biggest downside or the biggest risk here is that companies like Nvidia may also try to enter the custom silicon market. So there was an announcement that Nvidia may potentially be interested in entering this market. However, I would caution that hyperscalers are looking for alternative sources of supply. So you don't want to be relying on Nvidia for everything. So we think this is going to be a big market. Over $1 trillion of installed data center base needs to be upgraded. So there is going to be room for plenty of players like Nvidia, like AMD, and like Marvell.
Okay, so that's the stock you like. Let's talk about the stock that you don't like as much or you think investors should avoid, and that is Roku. And that stock, most recently in particular, has seen a dip in the wake of its earnings. Here, you're looking at a pretty crowded streaming market. We were actually just talking about that earlier with Michael Wolff, that there are a lot of players out there right now.
That's right. So we saw basically the consumer technology market drive the prior cycle, but now a lot of this has become very crowded. Streaming in particular is very crowded, and Roku is a player in this space. So as we saw from their latest earnings report, it's been increasingly difficult to grow in the US. That's the profitable market. So they're going to be facing challenges here as we look forward.
And let's talk about where some of that competition is coming from, right? Because it is big companies with a lot of resources like the Amazons of the world. So what does that mean for Roku?
So that's a pretty negative setup for them, because these big companies are investing billions of dollars in this, and they may not necessarily be doing it to generate profit. They may doing it to benefit other parts of their business. So that's a pretty big risk when you're competing with people that are not necessarily looking for returns on their invested capital in this space specifically.
Yeah, like in the case of an Amazon or an Apple, for example, that have those streaming offerings. And then if you look at the US market in particular, like we all have streaming stuff already. So how much more could a Roku grow? Are there, I mean, US is one thing, so talk to me about US, but also talk about international, if there's any opportunity there.
So there is an opportunity to grow internationally. However, the pricing internationally is much weaker, and this is a pretty significant tailwind when you have growth coming from lower priced regions. So we're going to see impact to margins coming from this point.
Well, just like we talked about what could go wrong for Marvell, let's talk about what could go right for Roku. And in this point, on this point, maybe we could see if there's a big tech rally that Roku could get caught up in it. Is that how you're thinking about it?
Well, that's right. We think we're at the bottom of the technology cycle. We just went through a pretty horrific 2022, and 2023 was the start of a recovery. So we expect a multi-year technology recovery, and Roku can be a beneficiary of that, just like any other tech stock. However, I would say that there is a lot more opportunities in the B2B technology space, where that space did not go through the same type of upturn that consumer faced. So that's a better place to be focusing on to look for upside.
Okay, and then just quickly, disclosure-wise, are you long Marvell? Are you short Roku? How are you positioned in these stocks?
So we own Marvell in our ETF, and we do not own or short Roku.
Okay, gotcha. All right, let's summarize what you have told people for them. You're telling investors buy Marvell. You think it'll be well positioned to cash in on the AI boom, and its products will be in demand. On the other side, you're saying people should avoid Roku. It's struggling in a saturated market and competing with some big players there. Ivana Delevska, thank you so much for joining us on Goodbye or Goodbye. I appreciate it.
Thank you.
And thank you for watching Goodbye or Goodbye. We're going to be bringing you new episodes 3 times a week at 3:30 p.m. Eastern on our new show, Market Domination, which starts on Monday. Stay tuned. We'll be right back. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
We've got some new details on the first big IPO of the year, Reddit. The Wall Street Journal reporting the company is eyeing a valuation of up to $6.5 billion in its market debut. That's far less than its valuation from just a few years ago. Now, the company is planning a target price range of $31 to $34 a share. That's according to people familiar with the matter. But this IPO is going to be closely watched, Julie, for a couple of reasons, as we've been talking about. One of them, that it's going to be one of the first big IPOs for this year when we've been in kind of this IPO drought. But also, I love and can't wait to watch how this thing goes with power users being able to buy in at institutional investor rates. I'm very interested in seeing how that goes, and the fact that Wall Street Bets is kind of a risk, but also definitely power users for Reddit, and what that dynamic looks like.
Yeah, it'll be really interesting to see. I mean, and it's interesting also getting this valuation news where it is. It could still change. That's always the caveat. Yeah. But sometimes you see these companies pricing it to get that first day pop, which maybe also is a nod to some of their retail users being able to invest and being able to profit from that. Who knows? But it'll be interesting to see if they do get that increase. A lot is riding on this, not just for Reddit itself, but every IPO analyst who we talk to says, that the other potential IPOs will be watching the first big ones very closely. Right. That was the case with ARM, and it fell flat, at least at the IPO. As we know, since then it's done quite well. Yeah. But, so we'll see if this sort of opens the door to more, or if it will end up being another one that kind of lands with a bit of a thud and doesn't prompt more companies to come out.
Yeah, especially because Reddit is unprofitable. I'm wondering what that's going to mean in terms of the IPO day. But to your point, maybe this means there will be a pop. We'll see.
We'll see. All right, let's talk about stocks more broadly. They're kicking off the month of March on a high note, but the good news may not last long. Womp womp. Jared Blickery, here are the details. What's up, Jared?
Hey, why am I always pouring cold water over these rallies? Tell you what, let me just pour cold water over my own analysis 1 month ago. This is how the year was supposed to evolve, and I've got it sliced and diced a couple ways. You're going to see here, February was on balance negative in 3 different ways. So for all years since 1949, and then when you consider the presidential cycle, year 4, and then also when you consider year 4 of the presidential cycle with a Democrat, that would be Biden. All 3 of those ended up negative. However, as it turns out, there's another way to slice and dice things that I had not considered, and this is seasonality for the entire year presented a little bit different way for an election year with a sitting president. So we have president that is running for re-election, and you might remember 2020, that's the last time this happened. Also happened to be a year of a pandemic, and pandemic outside of presidential control could throw things a little bit off balance here in terms of that analysis. So we've done this 2 different ways, and this comes from the Stock Traders Almanac. Jeff Hirsch over there doing Yo Person's work. Now, election year with a sitting POTUS is in purple here, and then when you take out the 2020, things kind of normalize, so you don't have as great a dip. But either way, you're going to notice that we don't really take off until mid-year. That would be after June, sometime in the beginning of July. That's when things get back to normal. So it might mean that if we were to follow this pattern, we'd have a few months taking it easy here. And for anybody who remembers last year, we had 3 months in the middle of the year where we didn't do much at all, actually sideways to down. So we'll have to see if this pans out, but it could be that March we're in for a little bit of a sideways to down trading action, guys.
All right, Jared, March is always an interesting one to watch. Thank you so much for joining us on that. We appreciate it. We are going to turn to the commodity market. Oil prices hitting $80 a barrel. That's for the first time since November. Joining us now to discuss, Greg Shernow, who leads PIMCO's Commodity Portfolio Management Group. Greg, thank you so much for being here with us. I know that you anticipate that oil is 15% below your broader target more broadly. I'm curious, what do you see as the biggest catalyst forward for oil then?
Provided OPEC continues to take the action that they have done for much of the last 2 years in supporting the market via reducing supplies, which has kept inventories very low, we continue to think that in this environment, we are going to draw inventories over the course of 2024. And that is one reason why we think we're going to have higher prices. In addition to that, one thing that's making OPEC more successful this time than, let's say, 4 years ago is the capital discipline has started to increase among U.S. And Canadian oil and gas producers. So relative to $80 3 years ago, they're spending meaningfully less than they would have spent. As a result, we expect growth, which has been a positive surprise in 2023, to start meaningfully decelerating over the course of 24. And that's going to allow them ultimately to bring on more supplies. But for now, they're able to effectively keep the market tight and prices supported.
And so, Greg, just to put a fine point on it here, OPEC is meeting soon, and you do think that they will continue to maintain the production cuts that they have had thus far. If that does happen, then what gets oil what's the catalyst for the next leg up? Is it the confirmation of that, or does something else need to happen?
To be honest, I think it's continuation of low inventories that are going to potentially draw further. You're starting to see the market term structure or the premium for prompt delivery accelerate. The front Brent contract is now 12% above 1 year forward. That's historically a fairly high level, suggesting that inventories, and it's consistent with inventories being very low. So if OPEC decides to start bringing oil back onto the market, that will help reduce some of the tightness. But in many respects, it's also a positive sign because the oil is needed. Ironically, cutting supplies to stop a market from being weak is not nearly as good as when you actually get to increase supplies into a strong market.
I want to talk about domestic risks a little bit. Obviously, we're heading towards another presidential election. If former President Trump were to take office, what could that do to the oil market?
Well, I think it's actually less impact on U.S. markets and more geopolitical consideration. What does, if Trump is elected, them stepping away from support for Ukraine potentially do to Ukraine's decision on their own security and their own defense? Over the course of the last few months, Ukraine has successfully attacked several Russian energy assets. And would they ultimately end up doing more if they view that as an existential threat, that they have to take that action, which maybe today they'd be more concerned about doing because of the required support from the U.S. government and European leaders who are sensitive to inflation. Similarly, I would expect a more aggressive sanctioning policy and more pressure applied to Iran. We've seen that in 2019, when the extreme pressure was put onto them, they actually were successfully able to attack Saudi energy infrastructure, which at that time was remarkable how fast Saudi was able to recover. But was that a warning as much as a complete attempt? And in addition to that, we've seen the efficacy of the Houthis in disrupting shipping. Iran has a similar capability of doing, really disruptive activity. And maybe the analog from looking in the 80s, when the U.S. and other countries were able to successfully keep the waterways open, now might actually be much more challenging given the use of drones and other military equipment that have come on that can make it harder to do that. So I think that there's real risks in a Trump presidency that actually geopolitics get less stable and as a result, potentially more constructive for oil.
That's really interesting and something that we haven't heard as many people talk about, Greg. Does that then in turn, if that does happen, one could imagine a scenario in which a theoretical President Trump would be alarmed, right, at seeing higher oil prices. That would not necessarily be good for him domestically if that translates into higher prices at the pump in the U.S. Could that, and again, I'm sort of going several steps into conjecture here, but he would tend to be probably more reactive than proactive on that front. So, kind of how would that play out?
Well, I think the first thing he does is he calls on Saudi Arabia, which has managed to take off a meaningful amount of supply from the market, who has roughly 3 million barrels per day of excess capacity. And in that case, ask them to bring on more supplies. Now, Saudi Arabia has the East-West pipelines that allow them to redirect some supplies. But certainly, you have to make that calculus. I've made a statement that I think Iran will respond. He may have a different view on exactly what Iran will do in that situation. And as a result, may make that decision. And then the minute he makes that decision, if Iran responds, you got to start calling on allies to try to replace it. Question is, how disruptive it will be, and that will be impacted by how much the allies can actually help.
Yeah, all of this really interesting to think about. And again, not something a lot of folks are talking about as of yet. Greg, thank you so much for bringing all of this to our attention, and thanks for your insight.
Thank you.
Well, check out shares of Fisker. The stock has been sliding in today's session. It is off the lows, however. Reuters is now reporting that it is Nissan, that's the car maker, in advanced talks to invest in the troubled electric vehicle maker. Fisker, remember, said as part of its earnings report last night that it was nearing a deal for a possible investment, but it did not name that automaker. This, as Fisker warned about its ability to continue to be in business because of its cash position. We're going to be speaking with the CEO of Fisker, Henrik Fisker, at 4:20 p.m., and we will, of course, be talking to him about all of this. In the meantime, stay tuned. We've got the closing bell coming your way next. There's your closing bell on Wall Street. It's Friday. It's the first day of March. Let's get a check of markets here because it looks like the rally has been continuing here today. The rally that we've been seeing this year. The Nasdaq leading gains as it has been and closing at a record today, up another 1.2%. The S&P 500 also closing at a record, up 0.8%. Remember, the Nasdaq finally pushed up to a record yesterday for the first time going back to November of 2021, joining the S&P and the Dow, but the Dow's not back at a record today. It's up about 0.25%, just over 90 points in today's session. And it looks like, I'm just seeing a figure here, the Nasdaq 100 up 2% for the week, its best performance going back to January.
That's great. I mean, it's interesting to see these gains continuing here. It looks like the S&P 500 Semiconductor Equipment Index is the best performer on the day. Not so surprising given that news that we had from Dell earlier. And when we take a look at the best performing members of the day, NetApp, your call out from earlier, Julie, the best performer today, looks like Palo Alto is still struggling this week off of their earnings. Interesting to see them still not, moving back to the upside. I anticipated that. But we'll get some more analysis here from our very own Jared Blickery. He's here with a closer look at the day's action. Jared, what do you have?
Thank you, Maddie. Indeed, a record-setting week. And just looking behind me here, the Dow narrowly missed eking out a win for the week. So it ended the week down. But we got some streaks available that are ongoing in the S&P 500 and the Nasdaq. Both of those are up 2 weeks. But what's more compelling is they are up 16 of the last 18 weeks. And here you can see the Nasdaq up about 1.74% for the week. And the small caps, Russell 2000, they got a 3% gain. So they are by far and away the winner here. Now, the sector action today, we had tech in the forefront. You can see XLK up there in the left, followed by energy and real estate. But we want to get a handle on the totals for the week. XLK, that is also the week's winner, up 2.6%, then real estate, then consumer discretionary, energy, materials, industrials, rounding out the top row. So we got a value and cyclical plus growth mix there. It seems pretty healthy. And if we take a look at our leaders here, we can see Bitcoin, the big winner for the week, as it was for the month, which I was going over yesterday. But don't count out the chip stocks. SOX was up 6.8% to a record high. I believe that's another record high today. IPOs doing well, disruption doing well. You can see ARK up there, 5.6%. Even solar bouncing back by 5%, which has been under a lot of water recently. And then just taking a look inside the Nasdaq 100, we have a few streaks. Nvidia has been up for, get this, 8 weeks in a row. Meta has been up 3 weeks in a row. So the record highs, that streak continues for a number of these that we've been talking about, guys.
All right, Jared, thank you so much. We always appreciate your insights there. We're going to go a little company specific here because shares of Spirit AeroSystems soaring today at the close here, up 15% after news that Boeing is in talks to buy the parts supplier, that the both companies of their struggling to address persistent quality control issues. So joining us to discuss this, we've got Ben Sakanos, S&P Global Ratings Director, and George Ferguson with Bloomberg Intelligence. And George, I want to start with you. Just give me your reaction to this news. What do you think?
Yeah, so I think it's probably Boeing management looked deep inside Spirit, thought about how they were going to fix the quality problems with the 737. The path to higher profitability, higher cash flow at Boeing is driven all through 737 build rates rising. And I think they thought the quickest path to quality and to higher build rates was through buying Spirit AeroSystems. And so that's what they're in the middle of doing, it sounds like.
Ben, I want to get your take on this as well, and also what the chances are that regulators who are already separately looking into each of these companies would approve a deal like this.
Well, I think it's a little early, but I would say that the biggest obstacle that's been, I think, discussed is the fact that Spirit also makes products for the competitor Airbus. So I think they would have to resolve that issue. I would guess that if it's gotten to this point, then some thought has been given to that, and that there's some path to resolving that.
What do you make of staying with you here? What do you make of Boeing continuing to kind of search for options in terms of partnerships, acquisitions? Is this an effort to shore up their supply chain?
Well, I think that the spinoff of Spirit has been a part of has been an obstacle, I think, to improving production over the last certainly over the last year. So I think that it's an indication of the limits of outsourcing, and I think that by bringing Spirit back into the insourcing of the company, I think that it would certainly simplify the quality control process.
George, so does this, it seems like it sort of increases degrees of complexity, though, if they're trying to do this deal at the same time that they're trying to solve these issues. So does it, is it a sort of walking and chewing gum at the same time, or does it, to the other point, kind of help solve that problem?
So I don't think Boeing management would undertake this if they didn't think it was absolutely critical to getting quality right in the supply chain. And so there is, I think, a layer of complexity because they're in the middle of trying to do a deal here. But I do think their ability to go into their major supplier for the 737 and make sure the processes are done correctly, make sure training and oversight is done correctly, outweighs, the challenge of having to manage a transaction. I mean, I agree. I think they'll need to get rid of some of the Airbus business. I think there's probably investment bankers already working on selling some of those businesses off to other companies that may want to add it to their portfolio. But again, I don't think Boeing management would have done it unless they thought this was absolutely the most likely path to get them to higher build rates sooner.
George, how should investors be weighing this news? We're seeing that Boeing is down here, and we're seeing that Spirit obviously up 15%. Is that the correct way to be viewing this news?
Yeah, I mean, what I've seen from Boeing today is they're not down a lot. I think if you're an investor in Boeing, and I just think about it from a very fundamental standpoint, and that fundamental financial standpoint is, I think buying Spirit AeroSystems gets you to higher build rates on the 737 and the 787 sooner. Those airplanes are the driver of profits and cash flow at the commercial airplane division. And so it's a positive for you because it takes away the uncertainty there and probably gets you closer to higher build rates sooner.
Ben, I'm curious because I know that you wrote recently talking about why you had not downgraded the rating of Boeing based on everything that was going on. If a deal, and I know, again, the caveat, of course, is that this is speculative at this point.
Right.
Would a deal like this change your calculus on the debt rating?
Well, it's important to note that this is still speculative.
Right.
We don't know if there's a real deal here, and we certainly don't know how it would be financed. Assuming that there were additional debt related to the deal, that would, I would say, make the credit measures incrementally worse. But I think longer term it would be constructive. I think it could delay improvement, but I think the company would still be on a path to improvement.
And George, I want to end with you because it's not just about the stock price. We also saw that Spirit's junk bonds were among the top traders in the secondary trading today. Is that a potential area for growth that investors could be looking to moving forward here?
So yeah, when I look at Spirit's debt, they have a number of debt pieces out there that are 9% type coupons, which are quite high. If you look at Boeing's debt stack, right, I think if you got sort of 10-year debt at Boeing, it's typically trading around 6%. I think you could, in an acquisition, again, we're speculating on everything, but in an acquisition, you could see some of that refinanced, and so I think if you own the 9%, you'd love to see it stay outstanding as long as you can because it's hard to get paper with that kind of return on it. But I think in a Boeing acquisition, it's probably going away. The debt stack's refinance, and that's one of the potential synergies inside this transaction.
George, Ben, thank you both so much for joining us on this Friday to talk about this potential news story. Hope you both have a great weekend.
Thanks.
You too.
Inflation has been President Biden's biggest issue for the first 3 years of his term, and just as that seems to be turning a corner, there's a new #1 issue for voters. Rick Newman here to talk about that. Rick, we talked about this a little bit yesterday. The issue is immigration. We saw both President Biden and former President Trump at the border yesterday. I guess the question becomes what he does about it and how he sways voters on it.
Right. This caught my eye this week. So in Gallup's monthly polling, the portion of people saying immigration is the #1 problem in the country, it was only 9% back last August, and now it's all the way up to 28%. And I don't think it's like that much has changed in 6 months. I think obviously what's happening is there's more awareness of this migrant surge at the border. And also now we're in the midst of a presidential election and Donald Trump is not now out there talking about it. So he's probably drawing attention to it as well. And Biden himself seems to be acknowledging that, yeah, this is a problem. I mean, it's a big one and it could derail his reelection efforts. So I think that's why he went down to the border yesterday to show he gets it. He's paying attention. He didn't want Trump to be the only one down there. He wants Congress to pass this bipartisan legislation, even though it probably won't. So the question becomes, what can he do on his own to fix the problem? And I think you have to break it down into two ways. The first thing he needs to do is show voters that he's trying to fix the problem. And the reason I emphasize that is anything he might do through executive action, very likely to be challenged legally. We saw that with Trump. But that Biden probably will try to do something anyway. And what a lot of analysts think is coming pretty soon, such as before the State of the Union speech next Thursday, is a Biden executive order trying to putting a daily limit on the number of people who can cross the border. And once you hit that limit, there is a limit in that legislation I mentioned. I think it's 4,000 people per day. And once you hit that limit, nobody else can come over until the following day. So that's a de facto annual or monthly limit, if you will. So let's see if Biden does something like that. I would point out that we're just getting news today that Biden is saying the U.S. military is going to airdrop humanitarian aid into Gaza to help Palestinians there. And I think what he might be contemplating here is how do you airdrop a solution into the border situation as a way to just get people's attention and make it seem like, oh, wow, they're really scaling up the effort here. So watch for something like that coming in the next few days.
Does that news from today that you mentioned, Rick, seem like something that is going to garner that attention and that political power that Biden is looking for?
The thing that I notice is it is a response to Biden critics. So we just had this primary in Michigan where there's a notable Arab American voter bloc and a lot of those people wrote in uncommitted as a protest vote against Biden. Also young people, very unhappy with Biden's full-throated support for Israel, at least up till now, and he's not been saying much about the Palestinians who were displaced. So Biden does seem to be listening to people, and we'll see how this airdrop plan goes. I mean, this is actually kind of risky. I mean, when you drop stuff out of the sky with a parachute, a lot can go wrong, such as one of the things that can go wrong is people see the aid coming down from the sky, they run to it, and if they happen to be in the wrong spot, it lands on somebody. So there's a risk this could backfire. Obviously, I hope it doesn't. And I think we're going to get better analysis over the weekend over why do it this way instead of bringing it in by ship or by truck or something. But part of the reason might be just to, make a big splash and make sure you get some attention for what you're trying to do, because one of the big problems Biden has had his whole presidency is he's not getting much credit for the things that are going right, especially with the economy, strong job markets, excellent economic growth. But he's getting a lot of flack for what's been going wrong, which is inflation and now immigration. So Biden needs to get people to notice things that are going right.
All right, Rick, thank you so much. As always, we really appreciate you joining us. Have a great weekend. Thank you so much.
Same.
Now, coming up, Fisker is in focus today on the back of its latest earnings and the report that Nissan is in talks to invest more than $400 million into the business. We'll speak to the CEO of the EV maker next.
Fisker shares closing the day sharply lower, but they did claw back some losses on a report that Nissan is in talks with the company to invest more than $400 million in the business. That's according to a report from Reuters. The EV maker reporting weak results yesterday, issuing a going concern warning and saying it will cut 15% of its workforce. Fisker CEO Henrik Fisker is joining us now. Henrik, first of all, thank you so much for joining us. Obviously, you have a lot on your plate right now, so we really appreciate you taking the time. I do want to start with that report from Reuters because you talked about in your call and in your statement that you were in talks with an automaker. Reuters is saying that it is indeed Nissan. Can you confirm that and give us any details?
No, I cannot comment on that, and I don't want to comment on speculation. What we have said is we're in negotiation with an OEM for development of electric vehicles and U.S. manufacturing, as well as an investment.
And so I guess then the question is, what are the next steps that you are taking, the next sort of concrete steps you're taking to keep Fisker up and running?
Well, what we are doing is we are pivoting into a dealer model where we are able to reach many more customers around not only the U.S., but also Europe. And that's going extremely well. We are signing up dealers almost every day at the moment. We have a huge interest because we have, I would say, the only real competitor to the Tesla Model Y, which is the best-selling EV in the world. And we have a longer range than that vehicle. We have features you can't get in that vehicle, and we are as good, if not better priced. So I think our dealers are really excited to finally get a competitor, to also get an EV from an independent EV maker, because so far all the dealers have been sitting about 10 years looking over the fence to see how other EV makers, new EV makers are selling direct to consumer. So I think they're very excited to get our vehicle.
I'm curious then, Henrik, and I understand you're not going to talk about the speculation regarding Nissan, but regarding any potential deal, would you be able to put a timeline on when a potential deal might be closing?
Well, we started talking to several OEMs, I think over 6 months ago. So we obviously have done a lot of work already. So I hope this deal will close as soon as possible that we are working on. And I can't give an exact timeline at this point in time, but it's not like we started talking yesterday. So this is definitely something that with that potential OEM, we expect to close as soon as possible.
You all are targeting production of 20,000 to 22,000 vehicles of those Fisker Oceans this year. I believe the fourth quarter production was just under 4,800. Can you give us any kind of update on what your first quarter has looked like thus far in terms of production?
So we are, we don't have production issues like many other startups because we have a contract manufacturer, Magna Steyr, and they are able to produce, if we want, 50,000 or 70,000 vehicles. So what we are right now going out with is a forecast of deliveries. And if that forecast turns out, or if it turns out that we can sell even more vehicles, and we actually have some dealers actually were a little concerned that we have enough vehicles for them. And if that's the case, that they can sell more vehicles, then we can raise production very easily. That's the advantage we have by having a contract manufacturing.
I do also just want to talk about some other deals that are potentially on the table. Another deal we've heard about is with Foxconn. Are you able to talk about the status of that deal?
No, I mean, right now we are concentrating on our OEM deal. That's in the main focus. We are a small startup company, so we have to concentrate on one deal that's very important for us. And we obviously are concentrating on what we think is the best deal for us long term as a strategic deal.
Henrik, as you look back, and this is your second go round, right, at a startup automaker. As you look over the past year or the past several years since you founded it, what happened this time that has brought you to this place? What in your view has been the biggest challenge? I know last time there were some exogenous things. There was a hurricane, for example. This time, what do you think has been the biggest obstacle to getting Fisker to move forward without getting to this sort of cash crunch position?
Well, first of all, I believe that we have a future. Otherwise, I wouldn't be here. And I believe we're going to manage to get out of this, I would say, general EV slump that there is out there. We still see a huge amount of interest in our vehicle. And, the EV market has been tough in the last couple of months, but I think with our pivot to the dealer model, we are actually going to accelerate our sales more than we have. We did have a 250% sales growth from Q3 to Q4. And with the forecast we are doing right now, we are continuing to see a sales growth despite the EV slump. And I think that's because we have such an amazing competitive vehicle that starts at $38,999.
And I know, Henrik, that the company said that the current capital may not be enough to sustain it over the next 12 months. There's potential challenge upcoming with the stock price and listing on the New York Stock Exchange. It really is sort of a make or break moment for the firm, and you're at the helm. So I'm curious about what that's like as a leader and how you're handling this kind of definitive moment for the company.
Well, I don't think it's a definitive moment. I think that this is based on obviously a concern going forward where you're projecting, I think, a certain scenario. I think what we are doing and what I'm doing is accelerating our dealer sign up, basically getting more and more dealers in quicker, which we are doing. In fact, we're shipping vehicles to the first dealer today, actually. So we have done that incredibly fast. We announced this end of January. So I've already 17 new dealer points, amazing, and we expect to have 50 by the end of this quarter. So what we are doing is trying to generate more cash quicker. And the way we are doing that is by increasing sales. And by the way, every car we are selling in the first half of this year is almost pure cash for us because we have already bought all the parts and paid for them. And we also have built cars that are in inventory ready to ship. So this is pure cash generating for us. And that's something that if that would not be the case, that would be more difficult. But in light of that, I actually feel very optimistic about our future.
We were just showing the share price, and Maddie alluded to the idea that you might fall out of compliance with NYSE and might be delisted. Do you think you'll be able to get back in compliance in time to avoid that outcome?
Yes, I do believe that. I mean, first of all, we have 6 months to do that, but I also believe what we have on the plate in terms of our dealer signs up, in terms of potential OEM strategic deal, all these things will happen way before we get to that point. So I'm very confident, and I believe that our share price will go up. In fact, I think they will do it already next month.
Henrik, look forward to catching up with you as you continue this journey. Really appreciate, again, you taking the time.
Thank you very much.
Thanks. Meantime, a market milestone for Nvidia, that company closing above a $2 trillion market cap for the first time ever. Today's gains seem to be driven by Dell's upbeat earnings report last night. That company pointing to a surge in orders for its AI-optimized servers, which happened to be made with Nvidia processors, Maddie. So, this was sort of a milestone that the market was anticipating, that Nvidia would get to 2 trillion. And there it is.
And there it is. It also sent the SPY ETF to the $500 billion milestone. So record-breaking news across the board when you have a name as big as Nvidia. But we've seen Nvidia do this before, obviously not at this record, but they have these higher highs and then they struggle to really break out past it between earnings prints. So I am curious to see what the catalyst will be moving forward to bring more growth for Nvidia as the earnings cycle starts to slow down a little bit. And then, of course, for retail investors who are looking at this and haven't gotten in on Nvidia, not good news.
Yeah, not necessarily, although, that we still talk to plenty of people who say it's not too late and that they will have more upside. Yes, we've talked to quite a few folks who are saying that, but there's also a lot of other chip makers out there, including Marvell. We talked to Ivana Delevska earlier today who likes that, although she likes Nvidia and AMD too.
Who doesn't? Well, switching gears a little bit, layoffs are plaguing the gaming industry this year. The latest rounds coming from Sony and Electronic Arts, but the 2024 numbers are closing in on the total from last year. For more on the gaming industry, we're going to turn to Yahoo Finance's Dan Howley. And Dan, I know that you had to leave the kitchen the other day when we were talking to go cover some of these layoffs, but I'm curious about what you're learning in your reporting about the kind of catalyst for these continued layoffs. We saw them happening over the course of last year, and now they're continuing again. Is this a sign that things are sort of at a breaking point for the gaming industry?
Honestly, at this point, it's somewhat difficult to say. We're seeing layoffs, as you said, Sony and EA among the latest. So far, there's been several thousand layoffs across the video game industry. And really what it comes down to is a kind of confluence of factors. There's the basic understanding is that it's a kind of similar trajectory that we've seen with the tech industry, but at a slower pace, where last year we had seen these huge layoffs in tech and then a slowdown in the layoffs. We saw layoffs in the gaming industry last year as well, but now we're seeing that kind of continue. And part of it, again, has to do with the huge amount of growth that had happened at the beginning of the pandemic. Gaming companies seem to have been riding that high, thinking, similar to tech companies, that the kind of good times for them, obviously not good times because of the pandemic, but for their bottom lines, wouldn't end. That clearly not being the case. We've seen growth flatten out, decline entirely in some instances across mobile games, PC games, and console games. And because of that, they're scaling back a number of plans. There's also the issue with interest rates at this point. Money isn't as cheap as it was. Games cost a lot of money now. I think the most recent Sony game from them, their Spider-Man 2, cost $300 million to make. And so, you know, we're seeing this kind of below, as far as pricing goes, continue to push that higher. Money not as cheap. It's difficult for those games to be made. That also makes hit or miss games not necessarily a risk that companies want to take. They want surefire bets. On top of that, there's two other factors. There's the kind of difference that we're seeing as far as gamers go and where they play. Younger gamers want to play on tablets and smartphones. That's impacting some of the consoles and PC sales. And then, there's gigantic games, so-called black hole games, live service games like the Call of Duties, the Roblox, the Minecraft, the Fortnite, that pull people in for hours on end, takes them away from other games that might otherwise have shined.
Very interesting stuff from reporter and avid gamer Dan Howley. Thank you so much. Appreciate it. Getting ready to book your spring and summer travel. We're breaking down the best ways to save and how to put those credit card points to use. That is next on Yahoo Finance. Affordability is top of mind for most Americans who are getting ready to book their spring and summer travel. That's according to a recent Hopper survey. With the best ways to save on those upcoming trips, we're joined by Yahoo Finance's Carrie Hannon as part of Yahoo Finance's Travel Guide 2024 Industry Insights. So, Carrie, what are some big tips for how people can save?
Oh, absolutely. I want to go right now. But the number one tip is to plan ahead. So, if you can book your airfare a month in advance, 2 is better, but now we're talking summer vacation there. Hotels, there's not as many great deals out there right now, but, anywhere from 10 days to 2 weeks is good there. But it's really important to think about when you travel. So the flights tend to be cheaper midweek, Tuesdays and Wednesdays, or returning on a Monday instead of on a weekend. So those are just a couple of nuggets to when you're planning. Number 2 is try to, if possible, travel at a non-peak time. So maybe you don't go right now in spring break, but you go in May, or you go between Labor Day and just before Thanksgiving. Those shoulder periods, you can have some terrific deals. Like, for example, hey, I want to go to St. Bart's. Well, if you want to go to St. Bart's at the end of October, trust me, you can find a villa a quarter of the price it is during the high season. And you might even get a free car rental at the same time. So think about those kinds of things. The third thing is use a price tracker, right? These things are fabulous. And most of the major travel apps have them. Hopper has it, Google Flights. So if you know where you want to go and roughly your dates, plug it in there, because even though we may say, oh, here are their fares, and they're getting higher as you get closer, there is a fluidity here. So they'll alert you when there's a dip, and if there's a dip, then buy it, by all means. The next thing is, please pack light, all right? Carry on your bags, because seriously, United and American both raised their checked baggage fees, and they're now like $40 to check a bag if you don't have their credit card or what have you. So seriously, I say pack light, and then you don't have to wait for your bags if they get lost. And the last thing really you should think about is, and I think you're going to explore this more, is your credit card points, right? That's a great way to find savings, or your loyalty reward programs you have at hotels and those kinds of things.
Carrie, I love the buy the dip advice. Fits perfectly into our coverage here, Yahoo Finance. Thank you so much. Really appreciate it, and have a great weekend to you. Thank you so much.
Thanks.
All right, well, as folks look to save on their spring and summer vacations, as Carrie mentioned, credit card points can be a smart way to keep your costs down when traveling. So joining us now with the best tips and tricks for putting those points to work as part of our 2024 travel guide, we've got Eric Rosen, the Points Guy's Director of Content. Eric, I'm going to jump right in with a personal question from a viewer named my mother. You're booking a flight. You don't have enough points to cover the flight. I told her to wait until she had enough points to buy it. Tell me if I'm right or wrong.
Well, you're right and wrong, I would say. There's certain airline programs that let you use points towards part of your flight, of course. But for now, you obviously have to rack up enough points to actually use those to redeem them for the flights. That said, you can also go for a variety of different credit cards, like a Chase Sapphire Preferred or an Amex Gold card, as part of your wallet, so that you can actually use those points towards the cost of your airfare without having to be loyal to one airline program or another. So there are lots of ways to play the game to save some money.
Well, and also you just heard Carrie Hannon talking about the importance of being flexible and booking early, which I suspect is also helpful when you're using points.
Absolutely. Those are great pieces of advice. Airlines open up their award availability about 331 days in advance, seems to be typical among U.S. airlines. Some don't schedule quite that far out. So if you know your plans well in advance, that's when you'll find that award availability. But also, to her point, if you're flexible, you can find some last minute deals. As airlines find they have unsold seats, they'll open those up for award availability. You can put those miles to use. You might just end up flying, on a Wednesday night instead of a Friday night, things like that. So the more you can be flexible, the more likely you're going to be able to put your points and miles to use.
And I know part of the advice is to utilize price alerts and to, again, be flexible. To your point, Eric, is there a moment, though, where you advise people to go ahead and pull the trigger and not continue to hold and wait?
If you've been tracking prices and they're within your budget, I would say just book the flight then. As you get closer and closer to the departure time, chances are those prices aren't going to drop. You won't see a precipitous, $500 to $200 drop on the airfare that you're going for. So if it fits within your budget, you've got a limited amount of vacation days, the kids are off of school, don't wait too long to book your trip. That said, if things really aren't in your budget, you might want to save it for a later vacation, sort of like she had mentioned, where instead of going on your spring break now, think about an early summer trip before everyone's out of school, or towards the end of summer, right before school starts again, where you might have a better chance of locking in a good price that fits your budget.
So Eric, Maddie asked a question on behalf of her mom. I'm going to ask a question on behalf of myself. I am not a points girl. And I'm just wondering and I have what is probably a mistaken perception in my mind that it's complicated, right? That navigating, accruing the points, and then using them, that it's somehow difficult to do. Disabuse me of that notion if it's incorrect. And tell me, who is best served by getting these points situations and cards and using them?
Absolutely. Airline programs, hotel programs do a really good job at making it seem very complicated to use their miles, or saying that you just need to rack up some miles and you'll get a free flight, and then you go to look and you're not able to find the thing that you actually need. If you want to keep things simple, there are a lot of ways you can do it, right? Get a solid cash back card like the Chase Freedom, right? So you can earn points on every purchase and then use those points for cash back, whether it's on travel expenses or on something else. We also suggest going for transferable points, something like Chase Ultimate Rewards, Amex Membership Rewards, Capital One Miles, where you can redeem them at a set rate for things like flights and hotels, so you don't really have to do a ton of mental calculations in order to get some value. Or you can transfer them to a variety of different airline and hotel partners that suit your need at a particular time, rather than having to stick to one program that might change its rules on a dime and leave you without enough miles for that trip you've been having your eye on for the last couple of months.
All right, Eric, one final question here. For the users out there who have been utilizing credit card points, I'm wondering about the kind of transfer deals that come up from time to time. What is the best way for folks to stay on top of those potential opportunities and capitalize on them at the right times?
Definitely. So what you're talking about are transfer bonuses, where instead of one Amex point to one British Airways miles or one Delta mile, for instance, you might get a 25% bonus. So if you transfer 1,000 of them, you'll get 1,250 miles instead of the usual 1,000. The best way to stay on top of those is to follow sites like ours, The Points Guy, because we have regular updates of what transfer bonuses are currently out there. And I would say, don't go speculatively transferring all of your points from those programs all at once, because you should have a specific imminent redemption in mind where you can really take advantage of that extra value, rather than counting on something coming down the pike in a few months' time. Because like I said, programs can change, or that hotel that's in one category of award redemption today could go up the next day, and then you've transferred all these points and you're not quite able to use them because you can't transfer them back to your other original account.
All right, Eric, we really appreciate it. Thank you so much for that advice, and have a great weekend. Thank you.
Thank you.
We want to update you on a story that we've been talking about, sticking with airlines. We're talking Boeing and Spirit AeroSystems confirming they are in deal talks. Boeing saying in a statement, quote, "We believe that the reintegration of Boeing and Spirit AeroSystems manufacturing operations would further strengthen aviation safety, improve quality, and serve the interests of our customers, employees, and shareholders." The company going on to say there's no guarantee a deal will get made. In after-hours trading, though, that didn't stop shares from moving. Boeing down a little bit, Spirit AeroSystems edging higher in the after-hours trading. And coming up, we're going to be joined by an analyst to break down 3 tips to managing your credit card debt. You and your wallet won't want to miss that chat. Bankrate releasing a new survey showing that nearly half of Americans expecting a tax refund will use it to save or pay off debt. For more on tax season and tips to manage that debt, joining us now is Bankrate Senior Industry Analyst Ted Rossman. And Ted, before we get into the tips, I am just curious about your perspective on the consumer, because we talk about this economic data all day, every day. We're not necessarily seeing this debt-ridden consumer that's no longer spending. So help me understand what's going on.
Yeah, I do think the consumer's hanging in there better than expected, but I think it's also one of these all news is local kind of issues. You know, people say credit cards are like power tools. They can be really useful or dangerous. It's all about how you use them. And it's roughly half and half in the credit card space. In terms of half are paying in full, they're avoiding interest, they're benefiting from rewards. The other half are stuck with debt at record high interest rates. The average is 20.75%. Consumer spending has been remarkably strong. I am starting to hear signals, though, that we're starting to reach a tipping point, maybe. You know, maybe this year there won't be as much travel, there won't be as much dining out. People are starting to rein in the budget a little bit.
20.75%. That is just an astonishing number. That 50-50 proportion that you mentioned, how constant has that remained over time?
More people are carrying debt now. Back in 2021, it was 39% who carried debt from month to month. Now it's 49%. Another way to look at it, 58% of people with credit card debt have had it at least a year. 3 years ago, that figure was 50%. So unfortunately, we're moving in the wrong direction. It has a lot to do with high inflation and high interest rates.
Is the last question on this before we get to your input here, but I'm curious about the debt to income ratio. What has that looked like over the past couple of years?
That's a silver lining. The household debt to income ratio is pretty low, historically speaking. I think that speaks to the strong job market, which is a very interesting disconnect in the economy now, where the job market's quite good. Consumer sentiment is not so good. I think it's really because inflation is just eating up people's wage gains. But this is one thing that has kept people mostly on track. Now, credit card delinquencies have gone up quite a bit. They've doubled in the last 2 years. But they were artificially low during the pandemic, and banks don't seem overly alarmed. So it's a little bit of the best of times, worst of times in the credit card world. It depends where you are on that spectrum, I would say.
All right, let's get to the tax refund survey, because it's interesting here that people are using the money to save, not to sort of like, not viewing it as sort of funny money, if you will, or free money that they can go out and spend. And is that a change?
The practical nature is consistent with what we've seen. What's new this year is savings number one, debt payoff number two. It used to be the reverse. Even as recently as last year, debt payoff was a solid number one. I'm actually surprised it's fallen, just given all that we're talking about with record high credit card balances, record high credit card rates. I really think using some or all of your refund to pay off credit card debt is a great choice. Now, savings is a worthy choice too, and frankly, the right answer for many may be some of both.
Well, but the thing is, if you're putting into savings now, especially if you're paying 20.75% on your credit card, and you're getting tops, what, 5% in a good CD right now, if that? I mean, it seems pretty obvious you should be paying down the debt.
Yeah, you're right. The math points that way if you have credit card debt. Right. It's a little bit circular, though, because if you don't have savings, then the next unexpected expense is going to land on the credit card. So there is some element of sleep at night kind of money. So it's not like get rich quick money, but it is peace of mind kind of money that next time the washing machine breaks or you have a surprise vet bill or something, you're not loading up the credit card. So that's where I think maybe some of both is the right approach, save and pay down debt.
The psychological component is such an important part of personal finance and spending. Where can folks go for advice, for good financial information about what to do if they are experiencing credit card debt?
Well, I'm probably self-serving to say, we have a lot of good info at Bankrate, but I'll give you more than that too. Nonprofit credit counseling is a great approach. Agencies like Money Management International and Green Path, they can really help people get out of debt. that's something that I don't think enough people know about. That if you have a low credit score or a lot of debt and you can't do it on your own, I would say 0% balance transfers are a great debt payoff tactic, but not everybody can qualify. If you can't qualify, go to one of these nonprofit credit counselors. They can negotiate a 7 or 8% rate over 4 or 5 years. It sure beats 20 or 25 or 30%.
Yeah, most definitely. Ted, good to see you in person. Thanks for coming in.
Of course, thank you.
Appreciate it. Coming up, what to watch next week. We're going to break down the stories you need to know to start your Monday. Time now for what to watch next week. Starting off on the earnings front, some big names reporting next week include CrowdStrike, Target, Abercrombie & Fitch, Campbell Soup, Broadcom, and Gap. Broadcom announcing first quarter results for 2024 after the bell on Thursday. The chipmaker has been red hot this year, up again today and up more than 20% year to date.
And on the economic front, it's going to be all about jobs. The monthly jobs report for February coming out next Friday. Last month's report starting the year off with a bang, but economists are forecasting job growth to start to slow down here. 210,000 jobs are expected to be added. The unemployment rate expected to hold steady at 3.7%.
And moving on to the Federal Reserve, Fed Chair Jerome Powell will give the central bank's view next week in 2 days of congressional testimony, giving us more insight into the path of potential rate cuts. Atlanta Fed President Raphael Bostic reiterating his views today, saying he wants to wait to start cutting interest rates until inflation recedes further, and that the Fed's job is, quote, not done. And of course, we can't let you forget the debut of Market Domination at 3 p.m. Eastern on Monday. You see there, we've got quite a good lineup of guests, and It's going to be fast-paced and fun, and you don't want to miss it.
And dominating.
Sure.
You're going to be dominating the news with all of these amazing guests. I saw that you've got Fran Horowitz, CEO of Abercrombie and Fitch. That's going to be great. Joe Bruce Willis, talk about the economy.
Jobs on Friday, yeah.
Who are you most excited about? I know you can't pick a favorite guest.
I mean, we've got Anthony Scaramucci coming on Monday, who's always fun. Urian Timmer, by the way, will also be joining us on Monday, investment strategist who always has interesting things to say. And so a lot of good voices that we're going to be hearing from. And then the jobs report on Friday. You know, as we just mentioned, the number looks like it's going to be a slowdown, but it's been coming out and beating.
And beating by so much. I remember the last one I got to be at NYCB for that, and the groans that I heard from all of the market makers behind me when that jobs report came out was really indicative of the vibe. But part of that could have maybe been seasonal, so maybe we do see a little bit of a slowdown. Certainly what the Federal Reserve would perhaps want, but I'm curious to see if we again see the market kind of slough it off if we do get a hot jobs report and say, well, Nvidia, we're fine.
Between that and Jay Powell, it should be an interesting week on the macro front. And it won't be Nvidia necessarily that they're shrugging off or shrugging it off for. It might be Broadcom next week. As we mentioned, it reports after the close on Thursday. And there is not as much chatter about Broadcom as there was about Nvidia. But of course, this is one of the other chip makers that a lot of the bulls on AI and on the chip space more broadly are also looking to right now. And so could that prove to be another catalyst, either to the up or to the downside? I think safe to say that it will start to get more attention as the week goes on. And it's already done quite well.
It's already done quite well, and we saw from Dell today, it looks like the momentum is going to only continue for these chips names.
Feels that way. All right, that'll do it for Yahoo Finance Live today. Thank you so much, Maddie Mills, for sitting in today. Come back Monday, 3 p.m. Eastern for the debut of our new show. Have we mentioned it? Market Domination. We're going to have all your coverage leading up to and after the closing bell. Have a great weekend.